Ladies and gentlemen, and welcome to our class, Understanding Charts and Price Action on Charts. Now, tonight's class is sponsored by CMS Trader, one of the world's leading Forex and CFD providers. And because they are the sponsors of tonight's class and they are a regulated provider, I need to give you a risk warning. So let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, if you want, during class, you can go to www.cmstrader.com and just click on the buy or the sell button, and it'll ask you to select a username and a password, and you can open up a demo account and follow along using their charts. There's no credit card required, no money required, and you can follow and also see how easy their platform is to use at the same time. Now, CMS Trader offers their traders extensive education, impeccable service, and no dealer intervention and no conflict of interest on trades because they are a fully regulated broker. They also offer free daily signals, unlimited access to their trading platforms, free daily updates and technical analysis, and super fast execution speeds. Now tonight, we're going to be talking about charts and how they can help navigate you or help you navigate the markets and make some sense out of what is going on out there. Because charts are one of the most important pieces of information that any of you can use. And you need to know how to look at a chart and understand what the price action is trying to tell you. Whether you want to get more complicated, whether you want to put technical indicators, whether you want to get involved in all types of things with charts, is completely up to you. But you need to be able to look at a price chart and understand what it's telling you. Learning how to read a Forex chart is considered to be somewhat of a science. They look complicated at first glance. Forex charts can look drastically different depending on what options you have selected. Now, charts usually have settings for the display style of the price and time frame that you want to view it. Time frames can be anywhere from 1 second to 10 years depending on the charting system you're using. Price can usually be displayed as a candlestick, a line, or a bar. Now, when you're using charts, the data is being fed into the charts directly from the markets around the globe. Now, one side note is you should realize that one of the reasons you would best use charts supplied by your broker that are live trading charts is because they have the fastest feeds in the marketplace, because feeds are extremely expensive. And so when you're using free charts or you're using some of the lower paying charting services, they have slower feeds. Some of them will offer you free charts and they give you a 5-minute delayed price. Sometimes you're paying for a minimal cost for a charting service and they're giving you a 1-minute delayed price. Okay, because all of this makes a difference on a computer, not your computers, but their computers and their servers, and also what they're paying for this data. Okay, excuse me for 1 minute, please. Okay, guys, I don't need you to constantly write in comments and make things that are unnecessary for me. Okay, I'm sorry to disturb you with this, but I'm handling hundreds of people out there, and we're not having a conversation. So thank you very much, but I'm going to turn off the question and answer ability tonight, and this way we can stop this flow of stuff so I can get the class done for you, because this class takes all of our time. Now, to begin with, before you can worry about feeds and data, let's talk about the types of charts that we have out there. Because there are three generally accepted charts. And these are known as a line chart, a bar chart, and a candlestick chart. Now, there's lots of variations of these, okay? But they're almost all simple variations. Now, there are some charting services that also offer some odd types of charts. But again, if you look at them carefully, you'll see there's simple variations, because today with HTML charts and Java charts, it is quite easy to make up unique charts and customized charts. But the three basic categories that we're looking at are line charts, bar charts, and candlestick charts. And these are the three standard charts in the marketplace. Now, I'm going to pop you up on and show you the charts. Now, we're looking at some live charts from TradingView.com. Now, TradingView offers a very nice service, and what we're looking at is I pay for my service. It's not expensive. But again, the problem here is when you're paying for the lower level, you get slower data feeds. When you get the free charts, they have a delay feed. Okay. And when you're trading in the markets, you need the fastest feeds possible, because assets, especially currencies, are moving continuously. Okay. Now, what we're looking at is a 1 hour chart for the euro US dollar. Now, all charts will give you a somewhere to pick up the symbol you're looking for and the time frame. And we're going to come back to time frames in a minute. But what we're looking at is a line chart. Now, when I give you information tonight, I'm telling you the rule of thumb, not how everything is, because I can't tell you what every charting service does, and I can't tell you what every trader does. But the rule of thumb for a line chart is you take the close of the period and put a dot on the chart and connect those dots together. So in other words, in a 1 hour chart, at the end of that 1 hour session, whatever the price of that asset is, you put a dot on the chart and you connect those lines together. Now, there are charting services, and almost all the charts will allow you to change it. And you can decide you want opens or you want midterm. But the standard rule of thumb is at the close of each period. So if we were looking at a 1 day chart, it would be the end of 1 day, at the end of each day. Or if we're looking at a one week chart, it's the end of the week. And it's whatever that price is at the close of that period is put on a dot on a chart. It's a very simple chart. It doesn't give us much information. It just gives us a general look of how the markets are going. Okay, most traders don't waste any time with a line chart because it gives you no real information. Now, you have used the open, the high, the low, and the close, but you can't see that on a line chart. And the fact is, regardless of what chart you're using, the price and what happened doesn't ever change. It's just how you're seeing it in what visual representation. Okay. The next chart, which is my favorite chart, okay, and you can see when I've used the drop down here, all the different types of charts that are out there. Okay, almost all of these are just variations of a bar chart, a line chart, and a candlestick chart. Like an area chart is just a bar chart with the bottom colored in. So bar charts are my favorite charting method. Okay. A bar chart gives us a lot of information in an easy to see visual format, because this chart that we're looking at here is exactly the same price, same time, same asset, same movement as the line chart. But what you get to do is you get to see the open, the high, the low, and the close for each period. So now we're looking still at the euro US dollar for a 1 hour chart. And each one of those bars represents the open of that period, the close or the end of that 1 hour, the highest price that that asset had reached in that end of that 1 hour, and the lowest price. And what happens is we can now see price easily, but we can also start to see common price points. Like as price is moving here, we can see that we have a significant price along here. We can see that we also have prices along this level. Okay, it may not always be the open or the close, but we have highs or lows or significant prices at this point. Look at this trend upward here. We can see all these lows and these bottoms touching that trend. We can see all those tops, okay, which are the highs and the lows. So we can see a lot more about price than we can on the simple line chart. Now, from here we go to the most popular type of chart, and that's called candlesticks. Now, candlesticks have been around since like about the 17th century or the 1700s, when Japanese traders used them to trade rice and predict the price of rice. Now, the fact is, each candlestick here has the same data set as the bar chart. It's got the open, the high, the low, and the close. The difference is we have colors on this chart, and this is a big problem for novice traders because they assume, or you assume, that the colors tell you something. And you think when you see a lot of red that an asset is going down or trending down and should be traded down. And when you see lots of green, you think the asset is telling you it's going up and you should be trading it or buying it going up. But that's not the case with candlesticks. And this is where we get into a little bit of a problem, because candlesticks are all about the previous candle, the current candle, the position of that candle, and the shape and the size of that candle. Okay. We're looking at, so the red area or the green area, and you can change the colors you want. With the new Java charts, you can make this purple and orange if you want, as long as you know which one is bullish and which one is bearish. Now, the fact is, you need to be able to understand what the body of the candle is telling you. This is the size of the colored in area, and then the wicks or the little bars that stick out or the shadows that stick out. And this is the story. It's not the color. Okay. It is the shapes and sizes and position of these candles. And there are names for them. We have Hammurabi, we have Marabuzu, we have Koji, we have Doji. We have evening stars, morning stars, hanging man, hammers, and we have inside out, upside down. We have 3 black crows, 3 white soldiers. Okay. And all of these patterns or combinations of candlesticks tell you something. Now, once you've learned it all, they are a great trading system or charting system. But unfortunately, too many traders don't put the effort and the time into learning how to use the candlesticks, and they start trading on the candlestick charts. Okay. Now, the chart's not going to hurt you at all. You can like the green and red candles and want to trade and do your technical analysis on this chart. That's fine. But remember, the psychological part, and we're human beings. We're all human beings. We react to these colors. You know, most of the world around the world, when we see red, it tells us stop from a stoplight. It tells green, tells us to go. So we have these reactions to these candlesticks, and they can, it's hard to put them aside. So that's all that I'm going to say. Okay. So my preference, especially for my charting, because today you can simply click on the buttons and change it from chart to chart to chart. My preference for building my charts is here. Because the first thing is you can see the price action. You're not overshadowed or psychologically affected by the greens and the reds. And once you have everything on here, whether it's your moving averages, your tech, you know, your Bollinger Bands, your chart patterns, whatever else, you can then switch it real easy back and forth and go look at the candlesticks. Okay. But just remember, the candlesticks are not about the color. Now, when it all comes down to, it's about seeing price action and understanding what the price is trying to tell you. Now, once you've got your chart established, that's just the bare beginnings of using a chart. Now, charts aren't all that complicated until we get to the difficult stuff. But I'm going to move it back to my bar chart. And once we have decided what type of chart we want to use, we then have to determine time frames. Time frames are very important. Okay. The first thing about a time frame is the smaller the time frame, the more incremental detail you're going to see about short-term trades. But if you're not looking for a very fast, quick trade, you don't need to see what a 1 minute or a 5 minute movement is. You're looking at a 30, 15, 30, or 1 hour. The time frame you're looking at has to fit into your trading style or what you're trading. Because looking at an asset in a 1 day chart, and that means right now we're looking at this asset in a 1 hour chart. So that means that this bar, let's see, my marker back on here. That means this bar right here tells us everything that happened with that asset in the last hour. Now, we can't see much on here, but we can see what happened 2 hours ago. We can see what happened 3 hours ago. We can see what happened 4 hours ago. And this is all the price movement we've had over those last 4 hours. If you're looking to trade short term, like most of us do in CFD and Forex trading, we're looking to be out of the markets before the end of the day or within 24 hours. Okay, you need to have the short-term information. Now, if you're just looking to invest in stock or buy gold to put away for your retirement, we would want to look at a longer-term picture. But if we were to change this to a 1 day chart, okay, we see a whole different pattern. But the fact is, it's very hard for any of us to trade anything intelligently using a 1 day candlestick. So what we're seeing in this candle is all the price action for that one entire day. Well, how are you going to make decisions of when to enter the market for a short-term trade when you're only looking at how price moved for the whole day? But it's important to look at longer-term charts to understand the personality and how an asset is trading. Because now we're looking at the euro US dollar. Now, the fact is, the screen is only this long. We're only going to fit so many bars on the screen. So we're looking at a 1 day chart. Okay, we can get a whole bunch of days on here. If we're looking at a 1 hour chart, well, it's taking us all of these bars to cover 1 day. So that means we see 1, 2, 3, say 4 days to maybe 5 days in the visual screen. Now, we can scroll back and see it all, but it's very difficult to not be looking at the current price. But we can move charts this way and that way. Okay, so if we wanted to see where the asset was a week ago or 10 days ago, we could do that, but it stays in that 1 hour chart. Okay. If we look at it in a 1 day chart, okay, we're seeing all the price action for this 1 day, but we're seeing way back 30 days, 60 days, 90 days, 3 days back on our 3 months back on our screen. Now, if we use these correctly, we can see that the euro, the current asset we're looking at, which is just no other reason that I picked this asset except it's the most popular asset in the world. The euro is trading in a very defined uptrend. Okay. Correct? And this is a long-term uptrend. It's been recovering since the price down here and moving all the way up to the 126 range. So we see it bottom down here at November 17th at 115 and is now moved up here to on the 5th today at 121. So we see that the euro is moving in a long-term uptrend. But if we move our charts back to a 1-hour chart, we see something a little bit different. Now, if we kept ourselves only focused on this 1-hour chart, we'd be saying to ourselves, oh, look at that, the euro is trading in a downtrend. The trend is simply the movement of the asset. Now, we would be completely right in saying that the euro is trading in a downtrend. But if you didn't know that the euro was trading in a longer term uptrend, so the euro had been trading up, and this could be a slight correction, and it's not a radical movement, because if we look, the euro remained in that uptrend. So all this is a very, very short-term defined little downtrend. But we know that downtrend is part of a longer-term uptrend. So let's say, hypothetically, you took your kids and say, you know, let's go back, back into the old days you see in the movies when people are drawing notches on their door frame as their kid grows. And you see the kids are having steady growth year after year after year. And last year you had this big spurt in growth and your kid jumped up pretty high. Okay, now, this year, you see it hasn't changed that much. Would you panic? Would you go to the doctor? Would you think something's wrong? No, because he had such a big spurt last year, and as compared to the marks on the door, he's had very steady growth. But on the other hand, if you saw that his growth was very, very slow, and it's even fallen less this year, you might want to go to the doctor and see if he's got a developmental problem. And maybe he has a medical problem or something you should be addressing. So just like the asset, they tell you little hints. They tell you little subtle information when you look at longer term and shorter term. Okay? And you're only going to see this. You're not going to really see this as defined in a line chart, but you see it in a line chart. And remember, a bar chart that we're looking at is exactly like all the prices do not change whether you're looking at a line chart, a bar chart, candlestick chart. The prices don't change if you're looking at a 15-minute chart, 1-hour chart, 2-hour chart. The prices are written in stone. Now, if you're looking at a 15-minute chart, you just know that it's broken down. So if in 1 hour, the euro moved from 121 to 122, well, that's fine. But if you break it down into 30-minute segments, maybe it made all that move in the first 30 minutes, and the next 30 minutes, it sat still. So the smaller the period, the more you'll be able to see that definition. So we're looking at a 1-hour movement. You may not see any movement, but if you divide that down to a 15-minute movement, maybe it had lots of activity in that first 15 minutes, then bottomed in that next 15 minutes, and then recovered in the next 15 minutes, and then took any bit of gain it did in that last 15 minutes. That's telling you the bulls were really in control at the end of that session. So the shorter the time period, the more definition, because if you still take those 4 bars for each 15 minutes and find the highest, the lowest, it's still going to be the same range you had in that 1 hour. It just defined it better for you. So let's go back to my PowerPoint for a second. Oh, let me get my marker off of here. Let's get this back to your. So we've talked about the different types of charts. We've talked about time frames. So each of the different time frames give us a clue to the personality of a trading pair. You can find out whether a pair tends to move steady during its trends, or if it tends to stall out. You can find out if it's volatile during a daily session, but steady over the week. Or sometimes you'll notice that it has a lot of volatility as the markets move from the Asian session to the European session. And maybe the markets are more volatile between 7:30 and 8:30 in the morning. You'll start to see little events, little personalities in each of these assets that will help you understand what to expect to happen and maybe offer trading situations. Now, viewing a currency pair in multiple time frames can help you find good entry and exit points, depending on the strategy you want to use. Day trading currency can make a lot of sense for traders looking to take maximum advantage of daily volatility, but keeping the daily trend in mind can help day traders focus on the bigger picture. Now, regardless of what I tell you, okay, Forex trading attracts many different types of traders with many different types of trading systems. If you want to trade a currency pair, it's best is to become as familiar with it as possible. There is no rule, there's no law, there's no thing written in stone. You can use whatever charts you like. You can colorize them any which way you want. You can look at whatever time frame you wish to use. You decide what fits you and your trading strategy. Okay? Do you want to look at 15-minute charts and 30-minute charts? Do you want to compare the two? Whatever is best for you, you decide. But the time frames should fit the type of trader you are. Whether you're looking to make trades in the morning that you want to close by the end of the day, or whether you're buying an asset because you think it's going to go up over the next 3 months, whether you're investing in a stock that you want to hold on to that's making part of your retirement portfolio. So if you're looking at something to buy for your retirement portfolio, do you really care if you bought Apple at 140.32 or 140.34? Don't really care, because you're looking at Apple to sell when you're retired, or to be, to split and doubled and God knows what, and be at 297. Okay, because you're looking to hold on to it for a long time and you want steady growth. Where if you're looking to trade Apple in a CFD and you're looking to trade a couple pips and use leverage and not actually own the shares of Apple, you want to get in Apple at the lowest price possible at the moment, so that you can make the most pips so you can close your trade later in the day and you pick up 18 or 20 pips because you use leverage and you only invested your $1,000 to tie up $50,000 worth of Apple shares. Okay. There's a difference, so the time frames become different. And one of the most important reasons you want to learn how to read a chart is so that you can place technical analysis on a chart. Now, not every trader believes in using technical analysis, but it can be useful even if it's not your primary method of trading. Technical analysis relies on price that is on charts that you're using, and most charting systems allow you to add technical analysis tools. Now, the way that I try to describe this is the more information you put on your charts, the more successfully you're going to arrive where you want to go. My example is when I was much younger, and I've been trading for 40 years, so you know I'm old. I used to have a business partner, and we were in London. Now, for me to get anywhere, remember 40 years ago, we didn't have computers and we didn't have GPS. So you got places with maps. Well, I wasn't really a detailed kind of guy. So if I had a meeting, across town, across the city, over in Brighton, wherever I had to go, I'd call wherever I'm going. They tell me what highway to take, what exit to take, and then they tell me how far they were from the exit. They give me some directions. Now, inevitably, I get lost. I'd pull into filling station after filling station. I missed the turns on the roundabout, and I always had to leave me lots of extra time to get to my meeting on time. But I'd always get there. Now, my business partner in those days was an excellent, excellent map reader. And he would pop the atlas out of the glove box, and he would look at it. I tell him the destination. Not only would he tell me what highway to get on, he'd tell me what lane to be on. If there was an accident, he'd tell me where to pop off the exit and get around it. He would tell me what time of day we should be going. When we got off at the exit, he would tell me to go to the third exit on the roundabout, and then look for the church, and then turn right at the church, and then go to the filling station, turn left, and then past the second stoplight, past the school, and I'll be at the parking lot where I wanted to go. He never got lost. Why? Because he could read all the details on this map. And if you look at the chart that I just popped up on your screen, you're going to see that that chart and this map of London don't look so much different. They all have little symbols that tell you everything, squiggly lines that go all over the place. But once you learn how to read them, you'll be very successful. Now, the most important reason we want to learn to look at charts and read charts is to be able to see how price has been moving that day, see how it reacted to specific events that happened that day. Say you want to see what happened and how far Amazon fell when Donald Trump came out and attacked Jeff Bezos. Or we want to see if the pound went up or rallied after the Bank of England did something. Or did the euro go up after Mario Draghi said something? And how far did it go up? Did it recover? Okay. After the Brexit vote, how did the markets react? Where did the pound go? So we want to be able to see all this in charts. The other reason we want to be able to look at a chart and see is so that we can put some tools on there. And again, anything done on a chart falls in the school or the area of this that's thought to be technical analysis. I put charts in a unique area of themselves because you don't have to get involved in technical analysis. I put charts in your basic trading foundation. And I also put three other tools in your trading foundation. Okay, it's to be able to put a trend line, a proper trend line on a chart. Not just see which direction it's going, but how to put a proper trend line on your chart, and how to put support and resistance on your chart, and how to look at volume. Because this helps you, these are 3 simple sets of rules that will help you understand how the other traders are viewing an asset. And trend lines are ultimately important because trend lines are one of the few things that has hardcore rules about it. So let's go back over to the Euro US dollar. And we need to put a trend line on the chart. And you can put a trend line on whatever chart you're working on. And you can have medium-term trends, short-term trends, long-term trends. Now, the first thing in order to put a trend line is you have to decide which direction the asset is moving, because you have uptrends, downtrends, and sideways trends. Now, you can have strong trends and you can have weak trends. Doesn't make a difference because we're not analyzing. Trend analysis is completely different than trend lines because trend lines have a rule. And let's start out with this one-day chart because it had a very nice trend for the euro. Okay. So here we see the euro is moving up. Now, a well-developed trend, not a trend line, but a well-developed trend will move in what we call push and ease, push and ease, push and ease, push and ease, push and ease. We can call them peaks and valleys. We can call them waves. You can call them whatever you want. But in order to define this trend, we have to be able to put a trend line on a chart. Now, a trend line starts out at what we call the significant low. The significant low would be the point where the price reversed itself and the lowest point it fell to. And we would extend this line forward, but no price action, whether it's a high, a low, an open or close, can break that trend line. That is a firm rule. Okay, and the thing about trend lines is they have very defined rules because it's the first thing that gives you some structure to price. So all the new charts will have a way to put trend lines on your chart. So let me get my markers off of here and let's use the tools on the chart. So we simply locate our trend line or our drawing tool. In this case, it's over here and we would just click on it. And we're going to click on our trend line tool and we're going to take it from this swing low and connect it going forward. And remember, as I said to you, it can have no price broken through it. That's the first rule of trend lines. The second rule of trend lines is you have to be able to connect two prices, a minimum of two common prices, without any price ever breaking through it. And that allows you to draw the trend line. It doesn't tell you have an active, valid trend line. It just allows you to draw the trend line. The trend line becomes active when, or valid, when you have a minimum of 3 points in common that touch this trend line. Now, it happens to be that we got unusually lucky with the euro because we start out here, so this is our first price in common. Okay. We then have a bottom here, and then we have one here. So we actually have 4 prices in common, or 4 touches to this trend line without breaking the trend line. Now that's very nice to start off because normally you only have 2 points and you're waiting for this trend line to get activated. So if we had drawn this trend line earlier, we might have only been able to draw it up to here if that's as far as, and it wouldn't have been active yet because we wouldn't have had the 3rd touch. Once we have the 3 touches, that trend line becomes valid, active, and becomes a valuable piece of information. Because now we've defined the trend. And again, we can see these pushes and ease, push and ease, push and ease, push and ease. And one of the rules of these waves is each low or each drop should never form a lower low than the previous low. So in other words, they should never fall below the trend line. But as you can see, each one of these lows is higher than the previous low. That tells us we have a very, very good trend. But we also get some critical information here. When we drew this price line, this trend line, and it became a good trend line, we then started several things happening. Okay. Now, we drew this trend line no different than a million traders around the world, because a trend line is not customizable. We don't have Barry's trend line and Maria's trend line and Michael's trend line and Lim Kwan's trend line. We have a trend line. Now, we can have short-term trends, long-term trends, and medium, but every one of those trend lines must follow the rules. Because what this tells us, it gives us a understanding of what we can expect in the markets. And when you know that you're looking at the same thing every other trader is looking at, you can say that a particular price is significant. So as we saw the euro US dollar falling towards this trend line here, now a price can break a trend line at any given time. And when it does, that trend line is over and you have to draw or find a new trend line. But when price approached this trend line, we would expect an action. Because all the markets are looking for that price on the trend line. So as the euro approached this 122 level, okay, we're expecting either the traders to let it bounce back up and push it to continue on that uptrend, or it will break through and end that uptrend, and the euro would start to move on a downtrend. So you may not know what is going to happen at the 122.81 level, but if you knew that something was due to happen at that 122.81 level, you can be prepared to respond as the markets react. Also, if you were trading this asset, say you, for whatever reason, you would already open a trade in the euro. Say you were back here with the euro. You had bought the euro expecting it to go up. Now, as price fell down, touched this trend line and bounced off of it, you felt pretty comfortable. When it came back down to that trend line, you felt pretty comfortable because this is the way a trend is supposed to go. So you were able to keep your position open because you didn't panic as the price declined and get out of the markets, because you waited for it to come to that trend line. Now, if it broke that trend line, you might have sold your position or closed your position. But because it didn't, you remained in that position and maximized your profits. Now, if it broke this trend line at any time, you might decide at that point to get out of your position. So that trend line is giving you the first piece of information. And it's one of the few lines that you actually drop on a chart with a very precise set of rules. Now, if we combine this with simple things like volume, which is just volume is telling us the amount of trades taking place or the amount of contracts being opened and closed in that asset. What we should do is see some type of relationship between the volume and the price. So what happened is, as the price was falling here, we see volume declining, because what happens is sellers aren't entering the market and buyers aren't entering the market. We see prices, we see the contracts are down or the volume is down, and we expect volume to move in relationship. So what we're expecting is volume to start increasing as the buyers return to the market. Now, if you imagine, buyers are in the market. They bought this asset at this point, and they're riding it up to here. The price edged down because what happened was the buyer said that price was pretty high, and they didn't start selling. They just stopped buying, okay? Because they say that's a little bit too high. So as the price eases down, because the buyers are just sidelined, at some given point, the buyers say, okay, that price is now low enough for us to re-enter the market, and they push that price back up. Well, that trend line is one of the key places where they would make that decision. And as we can see volume steadily increasing as price moved up. We don't have to panic because we see even as price is easing down to the trend line, we see the volume staying steady or moving upward. We feel pretty comfortable. So these are just some of the ways that we can use our charts to make smart trading decisions. But you have to get, number one, first comfortable with looking at a price chart, understanding what you're seeing on here, not technical analysis, not science, not art. You want to be able to look at this price chart and tell a story about how price moved today, yesterday, the last week or two, and maybe combine this with headlines of the newspaper, maybe with the economics count to see when Mario Draghi made a speech, how the euro reacted. And you can really tell how the economic events of the day, how the data came out, how the news headlines came out, because you can see how the price reacted. And you should be able to look at a chart, whether you're using whether you believe in technical analysis or not. No matter how you're making your trading decision, you should be able to look in that chart and tell a story based on price action. Because, say hypothetically, I work for Apple, okay, and I'm your best buddy. And I tell you, Apple's about to release a new product that's going to revolutionize, the computer industry. Well, you're waiting for Tim Cook to make the announcement, but you want to buy Apple. So you're all prepared to buy Apple. And you say, I'm going to buy it on the dip, and I'm going to be prepared for when he makes his statement. Well, that's fine. You've now made some very important decisions because you know some what we call fundamental information. But how do you know what price you want to enter the market? How do you know what price you want to exit the market? How do you know when to start worrying that maybe the price isn't rallying as much as you should, or you've maximized your profit? And how do you know where to put your stop loss? Because the only way you're going to find that is on a chart. You're only going to see the volatility of price action on a chart. So you have to be able to look at these charts and understand what price is telling you. Because then we also come to things like price patterns, like head and shoulders, triangles, wedges. All these are the reaction of traders interpreted on a chart, patterns put on a chart. You've all heard of flag and pennants, okay? These are all things that develop in the charts, and they actually develop from this first trend line, because You can then put other lines on this chart, which might tell you that you're in the middle of a flag or in the middle of a triangle, and then you're expecting a breakout of the triangle. But you can't do that if you don't know how to read your charts. So on that note, I'm going to say goodbye to everybody. Remember, this class has been recorded. You can access it in about 24 hours on investing.com under Webinars on Demand, and go over to CMS Trader, www.cmstrader.com, and set up a demo account. Use their charts, because there you're getting real live fast feeds, and you can start using their tools and start just trying to read the charts. Start trying to put your trend lines on charts, and join us for our class. We have a whole class on trend lines. We have a class on volume and support and resistance. These are basic foundations or building blocks that you should have on a chart before you start building strategies and putting involved complicated technical analysis on your chart. So join us for those classes. And again, thank you very much, and have a great night and a great weekend. Bye now.